Thank you very much. My name is Robin Harding. I'm the Asia editor of the Financial Times, and it's my great pleasure to moderate this fantastic panel on the US economy. The title of the session is Reading the US Economy, and I think there really is a lot to read and interpret. The big surprise for me as a European who's based in Asia is just how strong the US economy has been over the last few years, both in a cyclical sense, in the strength of growth, the stable employment, and also simply because productivity in the US has drastically outperformed other developed economies in recent years. And yet there have been all of these big shocks and structural changes, not least what we've seen over the last 6 months with the introduction and disappearance and reintroduction of tariffs, big changes to US immigration policy, big changes to fiscal policy and prospect. So I think there is a lot to talk about, and we have with us 4 real experts, all Americans, I'm glad to say, to tell us about it. Graham Allison, who is famous for many things, from his foreign policy career through to his teaching. Paul Grunwald of S&P Global, who I think previously worked at the IMF on this region of the world. Bob Koopman, who was chief economist of the WTO and currently editor-in-chief of the Global Value Chain Report, and Stacey Vanek Smith, formerly of NPR, now of Bloomberg, where she's the host of the Everybody's Business podcast. Let me remind the audience online that if you're sharing this via social channels, then the hashtag is #AMNC25. Okay, so I'd like to start from the shorter term issues and move out to the longer term. So the first question I'd like to ask you all is, why has the US economy been so strong? Why has employment remained so strong in the face of tariffs? Graham, would you like to go first?
Well, I'd be slightly contrarian. I think to say that the U.S. economy has been strong usually compares it to the G7 economies. But I've compared that to an Olympic race in which you only have old white guys running. So I think we've done well relative to some competitors, not that well compared to others. All these years, China has grown more than twice the rate of the U.S. Now, of course, it's a different situation. Second point, I think what's actually happening currently in the U.S. economy, most people haven't yet sort of integrated, which is that the U.S. economy has declined significantly in 2025. So I give people a quiz about this from time to time and say, what do they think's happened to the U.S. economy in 2025? At the beginning of the year, the consensus forecast was a growth rate of about 2.8. Some people even had 3%. Today, it's half that. So my God, if you've declined by half relative to what was happening, that'll end up having very big impacts as you work through the system. I think that's now being reflected in at least the public opinion polls. So you can see currently the most recent poll, approval rating of Trump's handling of the economy is down to 39%. And his overall approval rate is at 45%. So we kind of think this is the Trump world because he makes so much news. He won a tight election, close election. If in fact he had, it's just another way to understand the contingency in all this, or to be reminded of it. Imagine that the day before the election, he had announced that he intended to attack Iran. There's no way he would have been elected. So most of his constituents think what he did in this respect makes no sense, including many of the people in his government. So I think that actually as we watch what's now happening, while again, I'm red, white, and blue, and I look for the American team to do as well as possible, the current performance of the U.S. economy, in my view, is poor and getting poorer.
Okay, so the answer is that actually it is weakening. But Paul, I mean, the labour market at least remains very strong. I mean, it doesn't look, or I think feel to Americans like a weak economy, or am I reading?
Yeah, I'm going to be a little bit more mainstream than Graham. So if we look at the post-COVID period, coming out of 2021, the U.S. economy has performed significantly better than the peer group. I agree the peer group is the slow white guys, to use your analogy. But the last few years, 2023 and 24, the U.S. economy has grown by almost 3%. The speed limit, the sustainable rate, in our view, is closer to 2. So why has that overperformance happened? One is we're seeing very strong productivity growth in the U.S. Part of that has been helped by the Inflation Reduction Act and some of the investment around the energy transition. We've also had very strong new business formation in the U.S. And then we're kind of naturally helped by a high rate of labor force growth, a big part of which is immigration. As Graham said, some of that's starting to unwind this year. We had an artificially bad first quarter. The output was actually fell by 0.2%. The second quarter is tracking closer to 4. So if we take the first half of the year, we're kind of down to 2-ish. But I think the risks are on the downside. We can talk a bit later about where that's going. But the secret sauce has been the productivity growth, the new business formation, and the labor force.
Fantastic. Stacey, you talked to lots of businesses. What are they saying now about the current state of the economy in the sort of short-term macro sense?
Well, I really think that the sort of secret sauce of the American economy that's made it so resilient has been consumer spending. I mean, it's such a huge part of the US economy. It's almost 2/3 of the US economy. It's about 15% of the global economy. I mean, it is just such a force. And I think all of the stimulus spending that went in the early part of the pandemic and people continuing to spend really caused a lot of the business growth and a lot of the economic growth that we saw. What I hear from businesses now is a lot of concern. Their costs are going up because of tariffs, but also because of uncertainty around tariffs. They're hesitant to invest, they're hesitant to hire, they're very worried. They can't plan because they don't know how much things are going to cost. So, and also, they don't really feel like they can pass those prices on to consumers the way that they did. US consumers are in a really different position than they were during COVID when they had stimulus checks coming in and had some of the highest savings rates we'd seen in decades. So I think they're worried we're at a turning point. They're seeing their costs increase. They don't necessarily feel like they can pass that on. And they're, I think, starting to feel more and more squeezed. So they're quite worried.
Bob, on the tariffs specifically, why have we not seen more of an impact from what seem from the outside very significant tariff increases? Why doesn't that appear in inflation and in activity data?
Well, I think there's a number of reasons. I'll try to list them very efficiently. There was a lot of front loading of imports. So a lot of the inventory that firms are selling right now have not faced the tariffs, okay? There was, I think, a pretty significant slowdown in orders for new imports. So anything that comes in, and once inventories get drawn down, I think you'll see firms trying to either pass on the tariff through price increases, or I think also what's going on now, and they'll continue to do in the future, is try to find ways to absorb those tariffs in their margins or pass those down through their supply chains. Because of a weakening economy, I think there is a weakening economy, and firms are very worried about losing their customers, right? So I think that's a really big driving force as to why we haven't seen it show up. The other part is there's this sort of microeconomics to macroeconomics. So my research suggests that Trump tariffs of anywhere from 5 to 10% would likely slow the U.S. economy from a quarter of a percent up to 0.75%. I looked at various tariff scenarios. So that's headwind off sort of momentum growth. Right. But I think that the bigger effects are the macro spillover effects into investment. So Graham was talking about longer term effects. Paul was talking about investment effects. Those are the ones that take time to show up into the economy. There's lots of stuff where the ground has already been broken. They're still building it out. Some of that stuff was from Biden policies, but just also the dynamics of the U.S. economy generated a lot of investment. But right now there's a lot of holdup on investment. It takes a while for that to show up. And then consumers are starting to back off. There's uncertainty with consumers about whether or not they think the job market's going to stay good. You put all those things together, the direct micro effects of the tariffs are relatively small, can be offset by this front loading, margin absorption, those kinds of things. But I worry that those forces are going to be at play soon. They're going to affect investment. We'll get a reallocation of economic activity to less efficient activities.
So there's lags. Just very quickly, who pays for tariffs? Is it American consumers or is it
So
exporters?
it's the importer who pays the tariff.
Okay, but economically, who ends up paying?
So there are three sources, okay? Trump likes to say it's the exporters that pay the tariffs. Based on his earlier tariff policies and what we saw through the Biden administration is only about 5% of the tariff has been paid by foreigners. And so then you have 95% to explain. About 55% has been absorbed by firms and their margins, and the rest has been passed on to consumers.
Okay, very interesting. Well, probably welcome to the exporters in this room. The tariffs are not falling on you. Where does this leave the Fed? Because the previous sort of economic debate about the US was, well, after the pandemic, the Fed got behind the curve, inflation spiked. It's been a process of bringing inflation down. and they haven't quite got there yet. And now there's this huge uncertainty. The market seems to veer one way and then the next on what the Fed's going to do. What's your reading on that and what the Fed is likely to do over the next year?
I think the struggle between Powell and Trump has been vivid, and neither of them have made any secret about it. And I think Powell, in my view, rightly sees a very significant likelihood of continued inflation, and therefore has postponed a reduction in the Fed rate. And I think he'll continue to do so, because my suspicion is that as we see more of the impact of the tariffs and also of the chaos, which leads people to then be more cautious and with respect to the things that would otherwise be positive. And we also see the impact on labor that'll happen with the deportations, that I'm not betting on Powell changing his views. And Powell knows he's not going to be reappointed. And Trump finally now knows he can't fire him. So I think there'll be some drama, but I think we can pretty see the script.
Okay, so no change until Powell has to leave, which is next year.
Well, unless there should be some significant change in,
Yes.
Some surprise.
Yeah. Paul, what's your
Yeah, well, as I said, the economy's been running a bit hot the last couple of years, which is why the Fed has relatively tight monetary policy. They're still at about 4.25. We think the neutral rate is kind of in the low 3s, so they're about 100 basis points above the neutral rate. But we've seen other major central banks, the ECB, Bank of Canada, Reserve Bank of Australia, continue to lower rates over the last couple of months. The Fed has been standing pat. A lot of that is just the uncertainty we've been talking about on this panel. We know that tariffs aren't really inflationary, but they're going to raise the price level. So the reported inflation rate's going to go up. That could be 3.5% to 4% in our view by the end of the year. The Fed's targeting 2%, but they're watching the labor market. They're watching the speed of the U.S. economy, and they're watching to see if some of this jump in prices actually leads to lasting inflation. They're looking at inflation expectations over the next couple of years. So Chairman Powell and the committee have been pretty clear that they are, watching the data. They're in wait-and-see mode. But again, the U.S. economy's slowed a bit. Labor market's still tight, so they're in a space now where they can wait. If the labor market really goes south and growth starts to really go south, they will cut aggressively. We've got 2 cuts right now for the Fed later this year, and then they might finish the job next year. But they're going to be going gradually, and they're going to be keeping an eye on both the labor market and inflation because they have a dual mandate.
Stacey, is that in line with what you expect? And are businesses still counting on rate cuts coming through this year?
I mean, I think the real issue with tariffs, as you were saying, is that they can potentially slow growth for businesses and slow the economy down at the same time that they're raising prices, which puts the Fed has 2 jobs, right? Most people say you have 1 job. The Fed has 2 jobs, which is to grow the economy and to protect the currency. Well, the first job is to keep unemployment low and to keep inflation low, but this potentially puts those 2 things at odds. And Chair Powell was just talking about this tension at his last press conference that he's feeling, because if you raise interest rates, that will prevent inflation because it slows down economic growth and can slow down price growth, but that slows the economy down. But if you cut interest rates, which can help to bolster economic growth, and everyone's all excited about that, including the bond market, that can also cause inflation to go up. So the Fed is basically, you have to pick your poison a little bit in a situation where economic growth is slowing down while prices are rising. And I think the scary thing to a lot of businesses, and to me even, is this idea that we may go into, they call it stagflation, but with slowing economic growth and rising prices, the Fed is in a really tough position. They basically have to pick one thing or the other, and the U.S. has seen this in the not-too-distant past. They had Paul Volcker as the chair, had to raise interest rates enormously, really hurt the economy, really raised unemployment.
Okay, let's move on to sort of a more medium-term topic now. What I'd like to address is what the likely impact of some of these policy changes on immigration, on tariffs, and we should talk about fiscal policy too, will be on the medium to long-term growth potential of the US. But first, I just wanted to touch on why has US growth been so strong relative to others in the more medium-term sense, in terms of productivity growth over the last few years. I don't know, Bob, maybe would you like to take that one first?
Sure. So I think it's interesting. The U.S. has a relatively low regulatory burden, right? And it has a lot of innovation. It has very adaptable and flexible capital markets. So I think you see this, this confluence of firms being able to innovate in a relatively open, relatively low regulatory environment. Now, that may take us someplace we don't necessarily want to go. There's debates over AI and privacy around data and things like that. But the tech sector, the pharmaceutical sectors, these sectors have been able to really get the capital they need and the workers they need, and I think drive a lot of that productivity growth in the United States. You add immigration to that, the fact that we've funded lots of research and development over many decades. It creates a very nice sort of magic sauce where if you want to do something new, if you want to do something different, we also are very focused on efficiency and focused on bottom lines. All of those things add together to bring about that relatively rapid growth, I think.
But the thing I don't quite get about that is all of that was also true 10 years ago and 20 years ago relative to others. So why has there been this sudden divergence between the productivity performance of, say, the US and, say, Japan or Europe?
That's a tougher question, but I use the term relative, right? And I talked about relatively low regulatory burden, relatively flexible and adaptable capital markets. I think that, so I think, Greg, you mentioned it's like the old white men running, right? Yeah. But actually, it's pretty hard to, if you're already at the technology frontier, so places like China, India, they're far from the frontier. It's pretty easy to catch up. Yeah. Well, I shouldn't say it's relatively easy to catch up, but it's hard to push that frontier out. And we have, the US economy is one of those economies that really pushes that frontier out. And if you look at China's model now, China's really focused on innovation and pushing out that frontier. And I think that's a very good model. Many other countries, Europe, Japan, they sort of backed off that frontier stuff. They didn't really invest in it. They didn't push that hard on it. They were focused on other things.
And if I could just and agree completely, I think that if you look and see, if you look at the competition, so if the competition is Europe, who's characterized perfectly by Draghi's report, I think he's got it completely right. And you look at Japan with all of the issues it has as an aging society and otherwise, you're running against not the fastest, the fastest league. I think the U.S. has had all the features that you suggest. It's also had this great attraction, the ability to, if somebody really wants to do something or to make something, they come to the U.S. If they're starting up something in Europe now, they look around for a little while and they decide, gee, I can do a lot better in Boston or in Silicon Valley or otherwise. Now, if we do a good enough job, we may be able to discourage some of them. I hope we don't. But I'd say that a good part of the difference has been tighter, Brussels being more and more itself in all the ways that Draghi described, I think perfectly, and the whole system being unwilling to do anything with it, and then in the Japanese case, that's a more special case.
Robert, yeah, just very quickly, I think this kind of ecosystem that the U.S. has with the the risk-taking capital with the venture capital, and then you look at the tech sector where it's okay to fail and innovate, and you can scale that up quickly. Plus the U.S. education sector. I think that combination means a lot of countries essentially outsource that to the U.S. You see a lot of flows in for risk capital, education, et cetera. One thing we were talking about in the green room is higher education in the U.S. We're having a big debate right now, but we're getting talent from all over the world in our top universities. These are STEM folks, they start new businesses, they create value for the US. So if we're telling a productivity story over the medium term, that has to be part of the secret sauce you keep to maintain your high rate of productivity growth. If you start to damage that linkage between the education sector, the finance sector, and the tech sector, that's going to have negative consequences.
Yeah, okay, I mean, it does seem like the tech sector is a very big part of this divergence between the US and other advanced economies.
And if you even imagine the story that we're talking about, because so much of this is perceptions as well. Let's just imagine without the Magnificent Seven, the storyline, you would have the performance of the U.S. looking quite different. And if you look at the unicorns in the last decade and say, where did this come from? Half of them are led by people who were not born in the U.S. or their parents were. So this is a wonderful feature from the American perspective, but it's being the benefit of having a system that attracts some of the most talented people in the world and gives them an environment in which they can thrive. Yeah.
Okay. Well, so let's move on. There's a natural segue because it seems like the US has decided it no longer wants these things. It doesn't want talented people from the rest of the world. It doesn't want capital. None of these things. They're all bad. University is bad. Need to change these things. Is this really going to affect the medium to long-term performance of the US economy? Stacey, I'm going to pick on you first.
I think it absolutely will. And I think one of the things that you mentioned early in our discussion was the resilience of the US economy and why some of the tariffs and things haven't been showing up necessarily yet in inflation and in the job market. I think there is a lot of resilience, but companies, the founding of companies, this is a decades-long thing, and we won't necessarily see the ill effects of cutting off immigration, deportation, for a long time. Free trade has been very, very good to the US economy. It's basically been our policy since the end of World War II, and it's been incredibly, it has had a lot of drawbacks also, but net, it's been a huge gain for the US economy, as has immigration policies and things like that. We've really benefited so enormously. I think if those things go away, it'll take a little while, just like with the tariffs, the cost takes a little while to come through, but I think in the medium and long term, I hope it's not where the real damage shows up, but I fear it is where the damage will show up.
Okay. Maybe let's separate off the issues a little bit. Bob, which is the bigger potential problem for the US economy, the tariffs or restrictions on immigration? Which would do more to growth in the medium term?
I think the restrictions on immigration are likely to have a much bigger effect than the effects of the tariffs. The tariffs have these microeconomic indirect effects, reduces the efficiency of the US economy a bit, raises prices a bit, one time, but when you remove a factor of production from your economy, that has big direct effects. You're removing labor, it reduces your ability to produce output, it reduces the amount of money circulating in the economy to spend, the number of people generating that kind of expenditure. So I think definitely the immigration effect sort of per unit is bigger. I think the Trump administration is finding that it's harder to enforce their immigration objectives than they thought. That can be a relatively good thing, but there's also, it has a scary effect on many immigrants, so they keep their heads down, they don't necessarily engage as much in the economic activity. Many of them start their own businesses, right? Whether they're the university graduates or the construction folks, right? They're innovative, they work hard, and I think that's the bigger negative effect, okay?
I think if you dig into it, you've always had the legal and illegal immigration. You had, in my view, a irresponsible policy during the Biden administration where basically we had porous borders and even initially welcome whoever wants to come. And therefore, there are probably 10 or 12 million people who came illegally to the U.S. Some of those will end up being great entrepreneurs and otherwise. But relative to the people who graduate with a STEM degree from a PhD program, and we encourage to stay, so they're here legally, they're being legally educated, and they decide they want to work in Silicon Valley, I would say those are two different, kettles of fish. And I think that the part that seems to me that most dangerous is if the society seems unwelcoming to the most talented people in the world, and if the system is not recruiting them. Now, you could have another argument that says, well, how fair is that the U.S. kind of creams from the world? Well, that's another philosophical argument to be had. But I would say you cannot explain the predominance of American science and technology in the period since World War II without talking about people who were not born in America.
Yeah, Robin, if I could pick up on that, get back to the growth question, right? So the economic textbooks would say you grow by doing the same thing over and over and doing it a little bit better over time. But I think the reality is you grow faster by disruption, right? You come up with new technologies and you push out the frontier of knowledge, you push out the frontier of the whole economy, and that disruption comes from new inventions, and those come predominantly from the STEMs and the tech sector and everything. So if we're going to restrict that flow of talented immigrants from the rest of the world, that's going to, I think, inevitably pull down medium-term growth. So yes, the lower end of the labor is important and other things are important, but if that secret sauce for medium-term growth is gone, then you would have to be marking down the US
There's
economy.
another dimension to this, and that is Europe, Asian universities, they're all looking now to get the best talent out of the U.S. universities.
Absolutely.
That's a great comparative advantage of the U.S. The rest of the world's been outsourcing that to the U.S. university system, and why would you not want to hold on to that, right?
Well, and even in spite of the porous borders, we had a pretty serious labor shortage not that long ago,
right.
and that was preventing growth. That was preventing companies from growing. They couldn't hire. It
Exactly.
had an inflationary effect. So, I mean, this was across the labor market.
Does anyone want to speak up for the impact of tariffs? It seems like you're focused on immigration.
We had a little discussion in the green room. It's not green, I think it's beige. But, we separated the impact of the tariffs themselves from the uncertainty of tariff policy. So, we economists, we can put a tariff rate into the model and then relative prices adjust and the economy will adjust. If you have constant uncertainty about what the tariff is, what the level is, how long it's going to last, which trading partners are they, on all the goods, are they special goods, that has the tendency over time to push down consumption, push down investment, push down M&A. We've seen in our business that bond issuance is down. So it doesn't have to be an abrupt break, but that just puts a weight on the economy over time.
But that seems like a shorter term impact. That doesn't seem like
No,
a
that's long, man.
Well,
You're reducing the capital stock,
If that's a 1 quarter effect, great. If that's a feature rather than a bug of the new administration, then that's a 4-year effect, right?
Okay, we can have 4 years of tariff volatility, but presumably at some point, I think let's assume that the US settles down with significant tariffs.
Yeah.
What effect will long-lasting significant tariffs have on the growth and competitiveness of the US?
So I think there's two things. There's a reduction in investment. There's a reduction in foreigners' interest in investing in the U.S., so it reduces sort of the capital flows. And then there's a reallocation of existing capital and labor from those sectors which we were really efficient and really dynamic in pushing out the frontier. They now have to compete with textiles and apparel and shoes to get capital and labor, because those tariffs are going to encourage some of that production here. And my guess is part of that factor of production will be automation, because there'll be an unwillingness to pay workers to do some of this stuff, and might be an unwillingness of workers to do some of that stuff. So I think there's a longer term cost here in that it reduces our innovation, it reduces our capital stock, and it reduces the efficiency with which our capital is allocated.
So you think there will be some reshoring
I do.
manufacturing to the US?
Yes, I do.
Okay, well that will make Mr. Trump
I don't think it's
happy.
a particularly efficient thing to do. We've been at relatively full employment for capital and labor. We'll produce more for our own domestic market. There'll be fewer economies of scale. We didn't talk about this. We'll lose some economies of scale. We'll lose some network effects. We'll lose these innovation effects. These are These are all above the tariff. The tariff things are these little deadweight loss triangles. These other things are more rectangles and they're bigger.
I think Elon Musk had a good one-word summary for the tariff policy, and he called it moronic.
He likes that word.
There you go.
Well, the other issue too, I think, with reshoring is that because labor is so much more expensive in the US than it is in other parts of the world, it's going to push the price of things up, which means the US consumer is going to have less money with which to buy other things. And eventually, because consumers are such a huge part of the US economy, it's going to shrink or at least slow down the economy, which is a huge long-term effect.
Yeah, and if you flip that over, the reason these jobs were offshored is it was more cost efficient to produce them overseas, which was disinflationary. And if you bring them back onshore, it's going to put inflation pressure in the economy. Interest rates will have to be higher. It'll be less efficient. So this is not really a good thing.
Okay, there's one more area I want to touch on, and then we'll maybe sum this up, and then I want to get to the audience, because I'm sure you have questions. But it also seems to me there's a big debate about US fiscal policy. There's this bill going through Congress, and projections are of very large US deficits as far as the eye can see. Now, people have been fretting about deficits and fiscal policy for as long as I've been involved in looking at the US economy. But how much should we worry about that as a potential drag on the long-term performance of the US economy? Graham, you answer first.
I would say if we were thinking about systemic risks, that's the biggest systemic risk. And again, you're young, so you've only watched a little bit of this story. But the proposition that you can, as the U.S. is currently doing, spend $7 trillion and take in $5 trillion in taxes and more of the difference is not a sustainable position. Now, Herb Stein's line that, a trend that cannot continue forever won't. Okay? So that's for sure. But the question of when, that's uncertain. I think if you look, I remember vividly in 2000, the handover, the U.S. had actually eliminated our deficit. Alan Greenspan gave a famous speech saying, this is going to be a difficult problem for the financial markets because we're not going to borrow any more 30-year money because we don't need to be borrowing at that. So we managed to solve that problem in any case. And if you look at the gap since then, this is again, a country is not a company, and a country is not a family. And if you're have the reserve currency, you've got a lot more flexibility. But if you look at at this huge debt that's now I think it'll be $38 or $39 trillion. This is not a sustainable posture. And I think, therefore, you're hearing now very sensible. Take somebody like Jamie Dimon. Jamie is certainly not the sky is falling, the sky is falling. He's now fixated on the proposition, this bond market is going to crack. I don't know when it's going to be today, tomorrow, or otherwise. And there was a very similar conversation that went on in 2006, 7, 8, before the financial crisis, as people began to watch what was going on and say, this is not sustainable. So I would say this is huge, and I think unfortunately, in President Trump's big, beautiful bill, if it should pass, which I hope it doesn't, but the reason why you had the fallout between Trump and Musk was Musk looking at this as well, saying, this is crazy. You should not be taking an action now that makes this problem substantial. I mean, it'll only add an additional $2 trillion to the deficit over whatever, 5 or 7 years. And this is, I think it makes a nose. I think when we look at it in retrospect, we'll say this was totally irresponsible.
Paul, how would you characterize the
I'm
fiscal
going to
risk?
date myself here, but I remember when I was starting my career, we had the bond market vigilantes. This was in the Clinton administration, and when the markets thought the U.S. deficit was getting on a path where it was not sustainable, you saw a big rise in bond yields, and that prompted the administration and the Congress to get together and put a package to put the deficit on a path to which it actually reached zero by the end of the decade. The bond market vigilantes have been absent for a couple of decades. We've seen a little bit of rumblings recently, but I think we need that kind of interaction between the markets and the administration to signal that this sort of level of spending for the foreseeable future is not sort of in the interest of the markets, and then rates would rise and you get that sort of correction. Yeah. Maybe we see that again, but that mechanism has to be in place in order to get the debt to GDP ratio pointing downward, which is where I think you want it to go.
I mean, arguably, if the administration is going to spend more money and run bigger deficits, that's actually going to be stimulative in the short term. So is that going to offset some of the negative factors we've talked about at all?
I mean, I don't think so ultimately, just because the amount of our debt is getting so big, it is becoming quite a drag on the US economy. It's already the size of the amount of money we spend servicing the debt is already the size of the defense budget. And I think in the next decade or so, it's going to potentially become the biggest single part of our budget. So most of the tax money that we're paying will go to servicing the debt, which is money that can't be spent growing the economy or filling potholes or improving education or healthcare. And that, I think, is just a huge problem, because then when most of your money is going towards servicing debt, I mean, if you're a person, you know that it would be very hard to build a financial life that way. And as a country, same thing.
Yeah. But Bob, compared with others, again, I could keep coming back to portraying my European roots, but compared with others, the US debt problem still doesn't look that big. It's not Japan, it's not Italy.
Yeah, well, I'm going to disagree a little bit with Stacey. I think Trump's instincts will be to write checks. If the economy slows, if there's a danger of a recession, he'll write checks, he'll sign them. And I think he'll be comfortable with that because he's always worked his way out of debt by basically going through bankruptcy. I think that would be horrible for the US economy in the long run, right? But that's his view. So the question then becomes, does Congress actually take responsibility here, right? Congress is Article 1 of the Constitution. It has the purse strings. Is it actually going to step up and take control here? And I could see circumstances where it goes either way. I could see Congress basically saying, okay, we have to fix this. We don't trust the president to navigate our way out of it. Or I can see them doing what they've been doing the past few months, which is like, whatever you say, sir.
So Bob, tell us about the bankruptcy that is.
Yeah, I think we're not going to get into a future World Economic Forum panel.
I don't think he's thought about what that actually means.
How does this work? Yes.
Yeah, right.
I want to draw the threads together and then move to questions from the audience. And the way I want to draw it together is to say, we've discussed in this panel some of the things that made the US outperform other economies, both short and medium term. And then we've been discussing how some of the recent policy changes could result in big drags on that outperformance over the medium to longer term. So my question to you is this: are these drags going to decisively change that previous picture? So should we start to think about a future World Economic Forum panel in 10 years' time about how the US is the sick man of the world economy and it's underperforming everyone else? Or is this just going to make the US still the world's giant, but just a slightly shorter giant? What do you think, Graham?
So again, it's probably a terrible, I'm sure it's, but I already said it, the idea of thinking about a race that's limited only to the, aging, pale.
You can include all the young and vigorous from around the world.
I think if the Europeans should ever get their act together, which I wish they would do, then this would be a very interesting question. So if you imagine just magically the Draghi report was implemented, which I think it would be fantastic if it were. I mean, Europe has all the potential to be a serious, part of this race, but I hope that's the case, but I'm...
Well, let me ask you about China then. Forget about Europe.
I think for the China piece, my impression is that They have all the ingredients. There's a lot of tailwind, of headwinds and a lot of risk, but I think they have all the ingredients to continue right along the path that they're on, growing at generally twice or more the rate of the U.S. So that path looks to me like to continue. And here we certainly see lots of evidence of a lot of the kind of energy into building new technologies and new companies of the sort that has been the magic for the U.S. I still think somehow, maybe this is because I'm my affiliation or my faith, I guess, but I still somehow think the American story will end up writing itself. And I think that there's enough energy and positive impulse in enough different places that we go through some ups and downs, but eventually get to more or less the right place. But that's more of a hope than a certainty. Yeah.
Paul.
Well, very quickly, I agree with Graham on Europe. This is a huge opportunity if the U.S. is going to step back. They've been outsourcing a lot of things to the U.S. Basically over the last couple of generations. On the U.S. itself, I don't think we're telling a story of a crash. We're talking about a story where U.S. growth just gets taken down a notch or two over a very long period of time. Maybe the rate of innovation falls, maybe the rate of productivity falls, maybe the immigration story is a bit weaker, maybe we don't get as much talent in the U.S., and you knock down the potential growth rate by, a quarter of a point, maybe a half of a point. That's not going to move the needle in the near term. The U.S. is still going to be the largest, most powerful country in the world. The dollar is probably going to be the reserve currency. The Treasury is going to be the global reserve asset. But if you accumulate that over a generation or two, that becomes quite a big number. So the question is not, are we going to have some big crash in the next year or so? It's the world we're leaving to our kids and our grandkids as Americans. If you accumulate that kind of lost output over a generation or two, how much are we sort of subtracting from the story? And I think that's the big issue. So I would take the focus away from what's happening over the next 2 years and look over maybe the next 2 generations and think about it from that perspective.
Stacey, what do you think? And also, I wonder, do you think that, after Trump, things change back in the US, or do you feel like the Trump trajectory on tariffs and immigration is something that's here to stay?
That's an interesting question, and I don't know. Obviously, there's a lot of political agreement towards Trump's more kind of isolationist policy rather than the more global policy. As far as the effect on our economy, I think we have a lot of momentum as a country and a huge, very powerful economy. But momentum can change, and there's a lot of, one of the things that I've noticed with interest is a lot of the friend shoring that's happened since Trump, like a lot of other countries making alliances and trade deals. And I think there's a risk that those trade deals could cause a lot of a risk for the U.S., that a lot of those alliances could be really fruitful and that the U.S. could sort of isolate itself out of the global story. And the global story has just yielded so much growth for the U.S. And I think if the U.S. gets left out, it may have a more independent economy. But usually when economies get more independent and hunker down like that, it comes at a great cost, the great cost being growth.
That's really interesting. So you could end up with a huge US economy, but actually not part of the global economic success story.
That's the real risk I see, yeah.
Bob?
So I don't see the U.S. becoming the sick man economy of the world. I do think it could become more mundane. I sort of agree with Paul here. There's still, and with Stacey, there's still lots of very positive attributes for the U.S. economy. It's just that they'll be less positive. But I do think that has both long-term implications for the U.S. And the rest of the world. So what are the implications? Who's going to push out the global frontier? Who's going to solve some of these big global commons challenges? And then how do we organize cooperation and coordination around the positive and negative spillovers from trying to deal with those challenges? So in terms of recovery, I think there are real long-term costs to the Trump administration that any future administration is going to have a hard time overcoming. And you can think of it as lost goodwill. And if you're a company and you lose the goodwill of your customers, it's really hard to earn that back. And I'm afraid that just in 5 or 6 short months, many, yeah, we're getting into 6 years soon, right? It's going to be hard to get that mojo back and be viewed as somebody who helps solve
It's a
these
U.S.
problems.
brand issue, right?
Yeah.
Exactly.
No, seriously, it's a U.S. brand issue.
And trust.
So I mentioned the 5 months, or I was just, because this is essentially 1/10 of Trump's term, just to remember.
Okay, 1/10 of the way through. Let's move to some questions from the audience. I'm sure that there are plenty. If you would like to ask a question, then please raise your hand, and we should be able to get a mic to you. I'm looking around the room. I can't see right behind me. Nobody? Yes, I see one over there. The lady, or were you just stretching?
I just wanted to give somebody else I've been in this room and I've asked a question in every session. Hi, my name is Dr. Rupa. I am in global health, so this is not the typical room I'm in, but I'm a U.S. citizen. And one of the things that really stood out in the comments that came out was, I'm also an immigrant into the U.S., but that success for the long-term growth for the U.S. is on immigration, but you particularly pointed out STEM. And I'm particularly concerned about how some of the policy changes today are dismantling American universities, National Institutes of Health, just where excellence has come. And as a financial group, it would be great to hear how can we take the message you just said here, that without our excellence in universities and without our excellence in STEM, we're going to see a financial collapse, a financial slowing down. Because I think that message doesn't always come out. It seems that that's a critical message to get the people of the U.S. to say, look, we got to stop the destruction of our universities and our academic excellence.
Graham, and
Well, I think
affiliated with.
the ecosystem that was created essentially in World War II, at the end of the war, and the period thereafter, in which universities were enlisted in the national effort, in the first instance, for the war. So if you look at MIT and Harvard, they were completely entangled in what ultimately became most of the U.S. weapon systems and the war. If you look at the University of Chicago, or if you look at UCLA or at Berkeley, you have Los Alamos and Livermore are much connected. So, and there came then this flow of extreme talents from Europe mainly, often chased away by Nazism and Hitler and otherwise. But the people who made the atomic bomb were not born in America mostly. This is people like Einstein, Szilard, and then dozens and dozens of others. After that period, you've had this relationship between what became the National Academy or the National Science Foundation, the National Institutes of Health, other funding mechanisms in which universities have been kind of integrated in a loosely aligned ecosystem for basically advancing science and technology. And if you look at all the amazing success in almost all these arenas, I mean, Silicon Valley, it didn't happen to be in Silicon Valley, it happened to be around Stanford. The biotech revolution happened to be around Harvard and MIT. So the universities have been a crucial part of this process. And I think while there's many, many things that the universities have done that were wrong and stupid. So I can get you off on another thing about, I don't want to defend Harvard in all of its activities, or certainly other universities. And I think not appreciating how distant the image of Harvard and other elite institutions had become in the mind of a majority of Americans was a terrible, terrible mistake, and is a terrible mistake still. But nonetheless, this has been one of the great streaks of the American story. And I think that if it were undermined, I mean, again, if I were running the rivalry against the US, and you told me, I have a great plan. We can undermine this source of American strength he would say, "Fantastic! How could you do this?" It would be a brilliant strategic coup, which I think, unfortunately, Trump, at least in some of his impulses, is doing to ourselves. I still hoping this is going to get, sorted out, in which there'll be some substantial damage. There's already some substantial damage.
Stop you there, Graham. I'd like to ask you for your advice to the US universities, including Harvard, but I also want to let people ask questions.
No, apologies.
So, are there any more questions in the room? Yes.
Thank you. This is Katie, reporter from China Economic Net. My question is now, since many countries are negotiating with the USA for the tariffs issues, how will it impact their relations with the US, both economically and diplomatically? And are they going to shift away from the US in their national agenda? Thank you.
Okay. Who would like? Maybe Bob, that's your area.
Yeah. So, first of all, you can't negotiate a trade agreement or an economic agreement in 90 days. So, yeah, we could go into that. Now, I do think what the U.S. is doing here is this unilateral action is going to result in countries negotiating with the U.S., but it's also pushing other countries to coordinate and cooperate with one another. How well that develops, I don't know. There's already talk about Europe talking with the CPTPP countries. There's the ASEAN, the RCEP countries. There's lots of opportunities for countries to coordinate and cooperate outside of its bilateral relationship with the U.S. And I think Stacy said this earlier, that is, it could be very well the case that everybody else continues to cooperate and integrate and the U.S. gets relatively isolated. And that could have long-term economic costs for the United States. But it would be probably a relatively smart idea for the rest of the world to do that. So I think
Let me ask you this. How do you think the rest of the world's trade relations with China will change as a result?
This is a big deal. So if Europe talks with CPTPP and they start to cooperate and coordinate around going forward, the big questions as to whether or not it really isolates the U.S. is, can they coordinate and cooperate with China and India? Don't forget India, okay? And at this point, I suspect many of those countries would say, we have challenges with China, but China is more predictable than the U.S. So there's this uncertainty aspect. You'd rather deal with the devil perhaps, than the devil that you have no idea what they're going to do. So I think that's a big issue to keep in mind.
Can I jump in the back?
Yeah,
that's part of a slightly larger issue, which is, this Washington consensus we've had over the last couple of generations is gone, right? Built on, the free flow of goods and the free flow of capital and limited role for government. So the U.S. is at least partially pulling back from its historic role. We have to kind of, replumb or redesign the global economy and trade relations. And, there are poles in the global economy. The U.S. is a production pole, China is a pole, maybe Greater Germany, for lack of a better term, is the other one. So if one of those poles is going to pull back and become less integrated with the rest of the world, what does the rest of the world do to recalibrate that? That's a hugely open question, right? We haven't settled on the post-Washington consensus model, and this, I think, is just another part of that big equation where we actually land with that.
Well, my 2 cents on that would be, when we talk about decoupling, we should ask the question, who is decoupled from whom? Who's the most likely to be left with no chair to sit in? And I'm afraid it might be us. Yeah.
Okay. Yes, question there.
Carol Yu from Shenzhen Innovex Academy in China. I work with tech companies and tech incubation. So I remember that even at the height of tariff, I was talking to my companies and they were still saying that, even with 100% tariff, they still target the US market because they can still make money, right? And Trump wants to achieve, low prices, low inflation, low interest. It's not possible, not dealing with China by achieving his goal. So it seems, what you just talked about as well, very obvious, sort of like common sense. But the U.S. public, are they really not getting it? Like, how do you better educate so that they will vote for the right people to lead the country?
It's an age-old question. How do we get them to vote for the right people?
Explosive.
Stacey first.
I mean, that's a really interesting question. And the idea that in spite of tariffs, the U.S. is quite an important market still. The thing that is coming into my mind is tech products tend to be quite high margin products. They're expensive products. And so it still might be worth it to sell and really market to a US audience for something expensive like a laptop or a phone. But if you're looking at something inexpensive, like I was just talking to a fish wholesaler a couple months ago, and he was saying, they're just not placing orders right now. They're waiting until July 9th, which is when apparently we'll have a little bit more clarity on tariffs. But he was just like, it's not worth it in certain cases because the margins are so low on his products. So the first thing I'm thinking of is for some products, of course, it's still going to be worth it and to deal with U.S. markets, even if the tariffs are quite high. But I'm afraid for a lot of products, as textiles, food, things like that, and it's going to be really tough.
I will let the other panelists answer as well, unless there is one more question in the room. I'm just looking around. Anybody got a burning
gentleman
question?
behind you has a question.
Gentleman behind me. Yes, sir.
Yes, hi there. Sultan Hamidi from Saudi Arabia. My question is, I think Stacey tapped into the U.S. debt. Isn't the U.S. debt the big elephant in the room? I mean, it keeps increasing, and I don't know how high it could go and what is the impact on the economy and the U.S. economy. And will the tariff sort some of that issue or not?
Okay, we touched on it a little bit before, so I think that's it now for questions. So I'll maybe go round briefly to everyone one more time. And I think your question, sir, was, will the tariff revenue do anything? No?
I think it's 1/3 of the tax cuts, right, on a rough estimate. So if the idea of the tariffs is they're going to pay for the tax cuts, that ain't going to work. The math isn't there.
Okay. Bob, any thoughts on that?
Yeah, I agree.
I should have asked him. He knows more about this than I do. Right?
Okay, well, consensus on that. Okay. Graham, I'm going to give you the final word because we have to wrap up.
Well, I think it's been a very interesting discussion. I think the world spins faster and faster, and you can easily tell a negative story almost all the time, but usually it turns out better than we expected, and I think that's the fortunate part. And I think we haven't talked about technology and the other features that are actually transforming things in a positive direction almost as rapidly as some of the activities that have been having negative effects. So I'm optimistic looking forward.
An optimist, great. Well, I think that's a good note to end on. What I've taken away from this is that you're all very concerned about the policies of the Trump administration and the effect they may have on the US growth, but you are all, as befits Americans, believers in the US economy and that it will fundamentally pull through. And we'll see. And I thank you all very much for your time.
Thank you.
Thank you to our panel, please. Thank you.